Welcome to the SelfWealth Real Estate Podcast with your host, Luc Boiron. Today, I'm interviewing Austin Yeh, a friend and very successful real estate investor, landlord, multifamily property owner, wholesaler, flipper. Austin does everything. You may have heard of him. He has his own podcast as well as hosting a networking group, and he was featured in Toronto Life. Today, we talk about a lot of things, and we get into some nitty-gritty, deep conversations about different strategies and things we're working on. I think it was an excellent conversation. I think you guys are really going to enjoy listening to it. So tune in and enjoy the episode. Welcome to the SelfWealth Real Estate Podcast with your host, Luc Boiron. Today, I'm interviewing Austin Yeh. Many of you will know Austin Yeh through all of the things he's done, his podcast, Facebook groups, his wholesaling business, etc. But welcome, Austin. Thanks for joining us.
Really appreciate you having me here. It's about time you have a podcast, so I'm happy that you jumped into the game.
Thanks. I'm happy to be doing it. It's good to be able to talk to people, especially with me having moved to Ottawa. It's kind of good to connect with people and keep in touch. So, Austin, let's get into your background. What did you do kind of before real estate?
Yeah, before real estate, I had a pretty traditional background. So I studied business in undergrad, was working a couple internships, starting with accounting, consulting, and then I sort of jumped into the finance world. I didn't particularly enjoy it too much, the entire corporate grind, but I was just sort of following what my parents told me to do. So I worked there for a while and then wanted to find sort of a side hustle outside of that. So was dabbling around with weed stock. Lost money there. Just going on YouTube, running across Matt McKeever's channel, and then being introduced to the real estate world that way. But pretty traditional background for the most part.
Okay, nice. It's funny when you mentioned the weed stocks. I don't know if I've told this story before. I don't know how much I'm allowed to say. But when I was telling you earlier how I lived in Beijing in 2006, 2007, I taught English to some directors of a high-level bank in Beijing. And the guy I was working, one of the guys I was teaching, was getting stock tips from the mayor of Shanghai. So he was giving me stock tips to trade on one of the Chinese stock exchanges. And they went really well. And then the mayor of Shanghai got arrested for something, basically didn't make the party too happy, the government too happy, got arrested. And then all the stocks took a nosedive, and I basically broke even on all of it. That was my introduction to stocks, and I'd always been interested in real estate before that, and have been since. But that's just one of the things that kind of made it that I'd like to invest in something that I can control, like real estate, rather than it depends on the mood of the political party and who they're going to arrest and what mistresses they have. It was quite a interesting introduction to stocks for me. So, yeah. So you did the traditional background. What business school did you go to?
I went to University of Toronto, the Scarborough campus.
Oh, nice. Okay. Yeah. Okay, awesome. And so you went the traditional path, you started working, and how'd you start getting into real estate?
Yeah, so as I was working full-time with one of the big 5 banks, essentially while working there, I was moved to another department in sort of a computer science background, but I didn't study computer science. And I was like, okay, I realized that I have very little control in this job, and I'm just going to be moved around wherever it's needed. And during that time, the raises weren't that fantastic as well, despite having, 4 out of 4 reviews. So I realized that controlling my income would be fairly difficult in a corporate job. And so I looked into real estate through YouTubing. After dabbling in stocks, that didn't go well. Ran across Matt McKeever's channel. And he was one of the few pioneers on the online YouTube space, giving his journey on investing. And I figured that it would be easy enough. So those who know my story, just sort of fast forwarding it, is I went on YouTube, figured that it'd be easy, got way ahead of myself, went down to Windsor, contacted the first agents I could find. Because at that time, there wasn't too many organizations and meetups. So you kind of are just going through it yourself, or you're relying on Bigger Pockets, which has mostly American resources, not as much Canadian.
Yeah, or even for me, I wanted to do real estate, but I didn't know the groups existed, right? Even when I started, Rain was around and things like that. I didn't know it existed. I just tried to do my own thing, and obviously made a lot more mistakes than I would have needed to otherwise.
Yeah, no, exactly. So I sound like an old man. Back in my day, we would just go ahead and jump right into it. But that's what it was. I just jumped right into it, and I learned from the school of hard knocks. Fortunately, prices were much cheaper then, so I bought my first single family at 130,000. Essentially, after the realtor walked me through 5 or 6 properties, she asked me which one I wanted. I felt so bad that she dedicated all this time, so I thought to myself, why didn't I just buy whatever I could afford, which is the $130,000 property. So got myself into that property, then started listening to, not podcasts, but audiobooks, started watching more YouTube videos, then found out that there was a local meetup in Windsor, which was fantastic. And at that point, I got connected with contractors, with other real estate agents. And I found out sort of the way I was going about it was a little bit backwards. Usually you want to educate yourself a bit before you jump into it, but it was the other way around for me. So going into that property, there was a lot of mistakes that were made with that one. I hired any sort of contractor. It was a cash job. And so they took much longer than expected. Things went over budget. So that was a disaster there. And at refinance time, I wasn't sure what value I'd get, but prices were growing quite exponentially at that point. So I would say the market definitely bailed me out at that point. So I was able to refinance most of that money out, got a tenant to pay me 1 year rent up front. In retrospect, I should have questioned myself, how did this tenant get that money for the 1 year rent up front? But I didn't really, and that was sort of my first introduction into real estate. That deal went really well, although there were a lot of hiccups along the way. But throughout that process, I learned what it means to vet contractors, what it means to make deposits on contractors. Don't give all of that money up front. How to manage contractors, what to look for when walking in a house, so on and so forth. But that was that first journey there.
We learned so much from our first deals, from just taking action in any deal. And I would say, even though you've learned so much on dealing with contractors is still one of the harder parts of this business. It's still, no matter how much experience you have, there's no perfect system for dealing with contractors. If you're lucky, you get good contacts over the years of people you can trust and stuff, but it takes, there's always still difficulties. I mean, you know, we're flipping a lot of volume right now. And some of the contractors are better than others. There's a lot of delays, expensive. Yeah, there's some interesting stuff going on the contractor side.
Speaking of that, we're going a little bit off topic, but before we jumped on this podcast, I was on a call with a roofer who I hired from Niagara to go up to Sudbury, because the quotes in Northern Ontario are just outrageous for labor, lack of competition.
Yeah.
And so I called someone who was willing to drive down there, and I asked them if they did the roof for my garage as well. And they said, no, we never talked about it. I said, hey, buddy, I have the recordings of our conversation. It's like, well, let me send you over the recordings, because I record every call that I have. Sent it over to him, still waiting to see what he says. But
is he already back in Niagara? He'd have to go back up?
But he does other projects in Sudbury as well. I think a lot of people in Sudbury end up hiring him because the work is cheaper relative to the labor around that area, which is just a tidbit for anyone who's like investing in Northern Ontario. If you're able to find someone within 2 hours drive who's willing to go up, usually their labor is quite a bit cheaper. But yeah, that's another thing. I got recommended by a contractor from him, and it seems like he was trying to walk back on what he promised.
Well, that can be a really good
never
for listeners to record your calls with contractors. What do you use? What tools do you use to record the calls?
I use Open Phone.
So is it an app on the phone, or?
Yeah, it's an app. It's about $10 a month. You get your own number. All of my business calls with contractors, tenants, so on and so forth, go through that phone number. Because I also, although I hire a property manager, I very frequently speak with tenants in the case of non-payment of rents. We can get into that conversation later. There's been a couple that I've had. I don't want them to have my personal number. So I use Open Phone, and I record every conversation. Now, some people let the other side know that they're recording it. I personally don't. From what I'm familiar with, I think we were speaking, I don't know if you remember this, Luc, but a while back you told me that I think Canada had the one
party consent, I believe. Yeah, that's my understanding of it. Nobody who's listening take this as legal advice, but my understanding is, as long as one of the two parties, and there isn't, the other side of it is having a reasonable expectation of privacy. So if it's like, you can't record, I don't know, maybe a conversation in the toilets or something, like that kind of thing maybe. But otherwise, yeah, there's one-party consent, which means as long as one of the two people agree, which also means some random third person in our area couldn't like sneak a listening device to listen to you and I talking, that would be illegal. But as long as one of you or I agreed to it, we could record. But the other,
again, not legal advice. Go on ChatGPT for your legal advice. No, I'm joking.
I don't know about that either. There's this whole thing called lawyers. I don't know. They get educated. They learn how to do it. No, okay. Yeah, that's my understanding of it. Google's your friend.
But yeah, I record all the conversations now just to protect me from contractors, tenants, so on and so forth. Sorry, again, we went a little bit off topic.
Yeah, no, for sure.
It's just funny that you mentioned that because I'm literally going through it at the moment.
And you never stop going through it, I feel. So, yeah.
That's it.
Okay, awesome. Well, so where were we with that? You were dealing with your first property, and that ended up well, even though there were some hiccups. So what's next? What was next for you?
Yeah. After that, it was continuing to scale the portfolio. I'll admit at that time, I was going a little bit aggressive in the growth, which doesn't get talked about enough. Like, aggressive growth is fine, but a lot of people don't have the liquidity or risk tolerance to support it. But I jumped into my next project. That one was my first sort of joint ventureship, but we both put in the capital. We both put in the work. It was to get my feet wet and to split that capital risk. Because at that point, even though my first project went well, I did understand that the market appreciation did carry a lot of that project to making it successful. So I still wanted to continue to scale, but I wanted to split the risk. So went with one of my buddies for a joint ventureship. That project went well, pulled out all of our money for that one, then went into a duplex solo. Again, same sort of thing, rinse and repeat with these sort of projects. Market continued to appreciate, but even then, these were fantastic deals. And then I started to record, I should have mentioned, during this entire time, I was recording my journey on social media, on Instagram in particular, and my following started to grow more and more. Then I started in a meetup event in Ontario. About like 20 people showed up, and then went down to 5 people, and then went back up to 10. So I was holding monthly meetups while I was scaling my portfolio, while I was documenting everything on social media. And through that, I was able to raise capital for the first time. And all of that was without the expectation that I would raise capital. Like, I always wanted to somewhere further down the line, but I didn't have the network to be able to raise capital because everyone just graduated from university. My family, they work warehouse jobs, so not particularly wealthy. So it was sort of a mindset shift. I was documenting and showing things, and people started reaching out to me that were never in my network before, but they were impressed with what I was doing. So then I got into my first joint ventureship after doing 4 solo projects. And that one went well again. It's hard. It was hard to mess up with the market appreciation. When I say went well, there's obviously mistakes and learning lessons throughout. But just continue to scale that way through joint ventureships. And growing aggressively. And it wasn't until 2020 when the pandemic hit where I had my first taste of, oh crap, maybe things are not as rosy as I thought. So when things started shutting down, I had about 3 closings lined up. And these ones, a lot of them were not joint venture. They were myself because I got very confident in my ability, overly confident in my ability, overly confident in market conditions. And so with these 3 properties, I realized that it was going to be difficult to close them. I could pull from lines of credits. I didn't want to, but it almost was what it was. I painted myself in a corner. And that was the first time in my mind where I realized, okay, scaling too quickly, even when you have what may be good deals, if you scale too quickly and you lack the liquidity and you can't raise the capital, because at that point, no one was really loaning money as well, you could end up in a really bad situation. Fortunately, again, market picked back up, right? So I was able to get through those sort of closings. But that experience taught me that, yes, growing aggressively could obviously multiply your net worth, but at the same time, leverage can work in both ways. Things can change really quickly. And we saw that again in 2022. Fortunately, at that time, I was a little bit more prepared going into it. But yeah, it's easy for investors to get ahead of themselves. And I found that I did that early in my journey as well.
Yeah, I think it is easy for investors to get ahead of themselves, but there's also very few investors who try to grow or scale at the rate that you did. So it's a problem for the people who do it sometimes, or it can be a problem. It's a risk that you need to take into account, but it's not as common of a problem because a lot of people buying one property a year is scaling quickly, and you were doing a lot more than that.
Yeah, no, for sure. Another sort of, I guess, I if you don't mind, I'm going to share another sort of story that I had. So during the pandemic, when things started picking back up, I decided, and everyone was talking about raising capital in terms of private money, keeping 100% of a deal, which is perfectly fine, and a lot of people do it successfully. But for myself, again, although I had multiple investment properties, my capital base wasn't significant because I did refi the money that I put in these deals, but nothing more a lot of the time. Sometimes it's 5 or 10K more. So the capital base was maybe a little bit more than I started off with, but not much more. But I wanted to get into some of these bigger things, and I wanted to do it myself. So one thing I did during the pandemic, when, again, the real estate market was hot, was get out of my comfort zone and try to leverage private money. I think the way that I went about it in retrospect could have been better, although this deal, again, ended up going fine. So I got a 6 units under contract, and it was fully tenanted, fully below market rents, but it appraised higher than what the price was, than what I purchased it for by $125K, but on asset value.
And where is this?
This was in Sudbury.
Okay.
Yeah, there's a big differentiator between appraising on asset value versus appraising on the income, cap rate and income of the property. And at that point, when I saw the asset value was a lot higher, I told myself it was a good deal. And for a lot of people, it could still be good deals because there's upside potential. But I didn't really fully flesh out the thought of how difficult it would be to turn around units. So that was one of the struggles there. So I raised the capital, got 48% loan to value from Desjardins because the income was very bad on the property. And I raised the rest on promissory notes. So I went over 100% LTV when you include the construction and renovation costs. So a lot more debt than I was accustomed to for a single project.
And so I would say, because this is a differentiator a lot of people don't hear, you, like me, buy it less than properties are worth. So lenders are used to talking loan to value, but they almost never differentiate loan to purchase price, because you bought it for less than it's worth. So you might be borrowing more than you paid for the property, but still be, even with renovations potentially, still be below what you even paid for it, let alone well below the ARV, right?
Yeah. No, absolutely. You're absolutely right about that. I think a little bit, it becomes a little bit different with multifamilies because sometimes it's not a clear exit as quickly as you'd like. With these single family flips, like duplexes, you're absolutely right. You could lever up and still be like, you're going to be leveraged, but it's still a relatively safe investment if it's significantly below market because the turnaround's really quick. But with these multis fully tenanted, in this particular case, the asset value was important, but again, it's going to come down to income at the end of the day because it's fully tenanted. So fully levering up. Fortunately, I was able to convince all of the tenants to sign a cash for keys at 11 and to move out. So the turnaround went as planned. I hired a contractor down from Toronto, as we were talking about a little bit earlier, and bought him all the way up to Sudbury. He did the work at about 25 to 30K per unit. There was a lot of hiccups, though. So this contractor didn't speak English very well. So when it came to hiring local trades like electricians or so on and so forth down in the area, I still had to facilitate all of that. Garbage removal, junk removal, all of that. I still had to be very involved in that process. And then we're able to refinance all of our capital out. And it was May 2022. So as interest rates were slowly hiking up, fortunately, we're able to refi at the right time. That being said, although that project went well, the reason why I don't know if I would do that again. I would do multifamily again, but I wouldn't do the fully leveraged promissory notes on a multifamily again to the point that I was at, because if things didn't go according to plan, or let's say I refied now instead of last May 2022, I wouldn't have a clear exit to pay out all of these sort of promissory notes, right? So a lot of my real estate experience thus far has been pretty positive for the most part, but fortunately with these learning lessons I've had, all those things went positively. I realized that a lot of the time that things can go wrong because you see other peers out there who attempt the same thing and maybe it just doesn't execute as smoothly as expected. So when I do these multifamily now, and I still do multifamily now, I add in clauses that allow me to negotiate vacant possession prior to closing. And if I'm not able to negotiate vacancies with the tenants, because a lot of the time the landlords don't want to negotiate, they want the buyer to negotiate. If I'm not able to get the amount of tenants that I need to sign the N11, I can legally back out of the deal because that condition is in there. So I've done a few deals like that more recently, and I have raised private money on stuff like that because to me, it's almost like a flip, right? It's vacant possession. You know your clear exit in and out. You're buying it below market value. But yeah, I thought I wanted to share that. Speaking about,
I think that's a really good way of doing it is negotiating that ahead of time, getting the vacant possession, because it does change the risk of the deal substantially, because tenants can have so much control and you don't know. There's often not a legal way of forcing them out. It's only if you can get them to agree. If you can't get them to agree, they really dig their heels in. They fight you. They get a free lawyer through legal aid, etc., and they fight you all the way. It can really change the numbers on a deal substantially. So, yeah, having that certainty ahead of time helps a lot. Or your price drops substantially if you don't have that certainty, right? Has to be a huge. I always think there's a price for every property. Some properties are negative. Sometimes the seller would have to pay me to take it. But there's a price for every property. So.
No, that's definitely a good way of looking at it. Yeah, I mean, for me personally, price drops obviously are important. But again, if there's not a clear exit to that multi and it's going to be bleeding for years and years to come, I don't know. It's not within my sort of risk tolerance, but I completely understand that is the multi game in Ontario. Right, like that's how you make the money through tenant turnarounds. And if you're not willing to assume that risk, then someone else is, and someone else will get paid for it. But yeah, everything that I'm doing now, I have that I need some vacancies. I'm never assuming anything fully tenanted, especially because I'm going through some tenant problems right now, which isn't fun.
Oh yeah, I have some tenant problems too. But you know, my probably my favorite building is 24 unit in Brockville that I bought with 10-year seller financing. Interest-only payments for 10 years. And what I really like about that one is even though rents were half of market, I'm in no hurry to turn over the units. I want to, but I'm not reliant on pushing tenants out. So we're kind of getting some natural turnover, and then we're playing a bit of musical chairs. We're trying to get, market rents existing rents were 700 to 800, most units. Then we're turning over a unit that we can rent for $1,650 on the market renovated. And we're going back to the existing tenant saying, you're at $750. Would you rent this for $1,300 or $1,400? And now we get your unit vacant too. So we're kind of able to negotiate part way as kind of musical chairs method because their rents are so much under market. It's almost impossible to get them to move. We know that. So a bit of musical chairs, they get renovated units, they get ensuite laundry, and then we get their units vacant and we can turn over the next one. So, but with the 10-year VTB, we're not in a hurry to push people out. It's not we've got time. We've got time for natural turnover, and we really only need to hopefully turn over almost all of the units over that 10-year period.
Mm-hmm, mm-hmm. Yeah, no, that's pretty sweet. That's another way to make things work, right? Is I assume are you cash bleeding from that property or not?
When we bought it, it was about cash flow break even because it was interest-only payments.
Okay.
It's interest-only payments at 4% for 5 years, and then the subsequent 5 years at 6% interest only.
Mm-hmm.
So pretty reasonable. And with the 4% interest only with all the expenses, it just about was our NOI. Like it was pretty much break even. But again, we turn over one unit. We go from $750 a month to $1,650 after the renovations. It makes a huge difference in the cash flow.
Yeah. I mean, exactly. Like it's the time to get creative. There's so many creative ways that you can make deals work. Sort of the problems that I was presenting was going through the traditional route if you're going to raise private money on a multi, or if you're going to go 40% loan to value and you're assuming everything tenanted. But if you can get a VTB with the terms that you've stated, then obviously that would be a fantastic deal. People who are getting 1-year VTBs, I feel like that's not long enough. You're pushing the can only a year out, and you don't know where things are going to be a year out. But 10 years sufficient, as you were saying, sufficient time to turn around these buildings.
Yeah, absolutely. And we haven't pushed hard because honestly, I don't particularly enjoy doing that with tenants. Like, I don't love that, sometimes you need to do that where you need to push harder to get people to move. We did it on one building, in part because we needed to. We converted it from 12 units to 17. So we were combining units. We take 2 units and then divide them into 3. So basically, we would have had legal grounds for demolition, essentially, through the landlord-tenant board. So we were able to use that as leverage to negotiate with the tenants to get them to leave. And we did get the entire 12-unit building vacant. It took us, this is about 8 months, I would say, to fully get it vacant. But we did, and that was successful. But it's also, you just had we had a couple holdouts of units that we weren't renovating, or not renovating, but weren't splitting up. And so those ones were more traditional, like just cash for keys, and hope they accept it, because we couldn't rely on the leverage of, the N13. And those ones were much harder. The last tenant, we had to pay a lot more to get her out than the other ones. But I think it was good because the renovations in the building were so major overall that it was really good to have everyone out. It would have been too disruptive, constant calls to, city complaining about the work we're doing and stuff in the rest of the building and all that. So no, it was really good to be able to get all of the tenants out, but it's not enjoyable, the stress of wondering if they're going to get out or not, that kind of thing, right?
Yeah, I find now more than ever. So I've had a couple of conversations with tenants, some of them with some buildings that investors have that I was buddies of mine that I was trying to help out. And it seems like sort of the pattern that I'm noticing is that everyone knows what they have in terms of like under market rent unit. It's all over the media. It's all over the news. If you go on TikTok, if you go on Instagram, if you go on Twitter, all everyone talks about is the cost of housing, particularly rents. Housing prices not as much anymore, but all about rents and how it's bursting up double digits year over year. And so as a result, all of these tenants are armed with this information. And even when I went to go negotiate, hypothetically, I was never going to give them $20,000, but just like we're having a hypothetical conversation, just for me to gauge where their mindset was at with everything. Started off a little bit lower, then I said, okay, hypothetically, if there's somehow, some way that this owner is going to give you $20,000, and they probably won't ever do that, like, would this be something that you'd be interested in signing? And you have 2 years to find a place, because they were complaining about moving out too quick. So I was just going straight on, targeting all of their concerns that they had with the solution. And even at that point, they said no, because I know that $20,000 in 2 or 3 years right now, where am I going to be? Because I'm living paycheck to paycheck right now, paying 60% of market rents because every other cost has gone up. So I'm not willing to accept that $20,000. People are feeling it more in their wallets now too. So even though that their rent is sort of flat, they're seeing the grocery bill shoot up. They're seeing their fuel cost, insurance, so on and so forth shoot up. And they're noticing they're saving less and less. So these cash for keys conversations have become significantly more difficult. So we sort of did what you mentioned, which is we had some vacant units and started shifting people around. And all in all, the building value is going to go up. Maybe not to its max potential, but it's better than just leaving it with untapped potential.
Absolutely. I know we went off on a tangent here, but let's go back to your story. So you're doing a bunch of joint ventures. You started the meetup. You've done the podcast. All of this. Let's get into what you did next.
Yeah, absolutely. So was doing joint ventures, started up a meetup, and that slowly started to scale and grow. And during that entire time, I was really big into branding, into social media, into branding. That's what got me to raise my first couple of JVs. So what I started to do was I started to reach out to a bunch of news outlets, so cold emails. So Toronto Life, Toronto Star, I think it was the Globe and Mail. I just sent out a bunch of emails with one paragraph introducing myself and seeing if anyone wanted to publish a story on me. And 2 news articles came back, Toronto Star and Toronto Life. Then the pandemic hit. And of course, they backed out of that news story and said that they wanted to focus on COVID-19 news only. So they're putting everything else on pause. And during COVID-19, real estate market dipped, started to climb back up. And I followed up once again with both of them. Toronto Star was not interested anymore, but Toronto Life was interested in publishing the story. So for those followers of mine, most of them probably are aware of me through that Toronto Life article where it explains how I scaled up to 18 properties. And I don't remember, it was like 2 years or something along those lines.
You were quite young at the time still. You were, yeah.
Yeah, I was about 25 years old when that article came out. And that's what really moved the needle in my branding. And that's what really moved the needle in my podcast. All of a sudden, my podcast went from 50 to 60 downloads per episode to, I think like it was 4,000 or 5,000 downloads an episode. So it brought a lot of attention over, both positive and negative attention. But I capitalize on that, right? I use that to grow the Rise group, to host more meetups, to host in-person events, speaking events, engagements, having courses, so on and so forth. So I continue to scale sort of the event side of things during that time, and that continued to go well. And throughout all of this, keep in mind, I was working my full-time job, so it was hard to juggle and manage everything. And although my portfolio was growing in real estate, I noticed that my cash flow was still pretty inconsistent for the most part. When there's capital calls, any of the cash flow that I generated would go back into the property. So I wanted to find a more active way of making money in real estate, and that's when I ran across wholesaling. So during the time I was scaling my portfolio, there have been a couple of properties that I didn't want to close on myself because either it didn't fit my criteria or I had way more than enough projects that I was working on. And so I would just go on, I think it was your Facebook group actually, where you have a wholesale, one of the biggest ones in Ontario or Canada. I just throw it on there. And someone messaged me, spoke to them, and then ended up wholesaling a deal for a $20,000 fee. So that was my first sort of experience with wholesaling.
Nice.
And that one was a little bit chaotic. I didn't know I was supposed to get a lawyer to represent me on the assignment. So I sort of half-assed that assignment. It went well, it closed, everything went great. But again, I took too many steps forward instead of understanding the process.
I mean, and you don't need a lawyer to on your side of the assignment. It just makes the transaction go much smoother. There's a lot of things you don't need to do on assignments, but that if you do them, it helps it go better, for sure.
Yeah, so exactly. So one of the reasons why the lawyer would have been nice is because the buyer wanted to push back closing a couple of days, and I didn't know how to handle that, and it would have been nice to get some legal advice. But you're absolutely right. And throughout that process, I did another small wholesale, $2,000 or $3,000 fee, like pretty small ones on the side, but it was pretty consistent income for the most part. I did a wholesale as well, and I found that my capital base was growing much more significantly than just these buy and hold properties.
For sure. Do you mind just defining a wholesale for people who don't know?
Yeah, a wholesale is essentially buying a property, closing on it, cleaning it up, and then just relisting it on the market and collecting the profit that way. Obviously, you need a lot more spread because you're going to have realtor fees, you're going to have down payment, holding costs, land transfer tax. So you do need a decent amount of spread if you're going to be doing a wholesale. But through that wholesale, I think I made about it was me and someone else who closed on it. So we made about $20,000 each. So my capital base was growing much more significantly through these active means of income than it was through these buy and hold real estate. But the buy and hold added more to my net worth, right? Yes. So they both went hand in hand. So while I was working at the big bank, I figured that I would go all into real estate, into wholesaling. So I partnered with Waylon McGill for Ontario Property Deals. And Waylon was a pretty new wholesaler as well, but he's had a lot of experience in sales. He was a tech lead in sales. So I think and I had more experience in the real estate side of things. So it was a good sort of combination there. And we're able to scale just immediately off the bat, we sunk in a lot more money than we made at the beginning. Let me make that clear, right? So like we got Salesforce, which was really expensive. Maybe in retrospect, we didn't need Salesforce as a CRM system, but we invested in Salesforce and all of the systems. We joined the 7-figure flipping mastermind to continue to grow on our systems and build on our network. So we sunk in a lot of money at the beginning, but as a result of that, and obviously the market doing well, but of course a lot of our efforts as well, we're able to grow into 7 figures in revenue in our first year, which I was really happy with. And I would say a month into wholesaling, I ended up leaving my full-time job and just going fully committed into that avenue. And ever since then, that has been, for the most part, the primary income stream.
Nice. And so since then, how obviously the market started changing kind of in early spring 2022. How have things been going for you since then, and what have you been up to?
Yeah. So there was a lot of pivoting that was required. As we were scaling, we wanted to tighten our margins. At the beginning, him and I were doing everything ourselves. So our margins were fantastic. It was like close to 70% because we didn't really have any hires. Then we hired an admin, a virtual assistant from the Philippines. That made the margins a little bit less, but not drastically because the pay is pretty reasonable for the most part. Then we had a couple of acquisitions managers where we were paying a percentage commission, but no base. And it was a large percentage of commission. We wanted to rein that back and move everyone to a fixed model. So like fixed income, salary, so our margins improve, and then have them collect a base plus a smaller commission. They were all thrilled to switch over to that model. Mathematically, to us, it made sense just looking at where things were and where we anticipated the company to continue to grow. But as you mentioned, things changed and our margins changed pretty drastically as well. Because at that point, we had 4 people on payroll. And that was quite a lot because we saw our volume dip down pretty drastically. So one of the big pivots we did was we continued to market. We wanted to see if we were able to move deals. We were able to get things under contract, but buyer sentiment changed drastically. So we offered people to switch back into commission. We had to restructure our company a little bit as a result of again, we're a new company and we grew too quickly. We made 2 quick business decisions. So we had to sort of to reverse that. So once we got back to a stable place and being profitable again, by adjusting sort of our expense basis, we continue to market. Right now, what we're finding, and I don't know, for your business, it might be a little bit different. But for our business, what we're finding is that buyer sentiment is still pretty slow for the most part. We're not moving every single deal. Before, you can move any deal. No one would need to walk through the property. We're probably moving 50% of the deals. And even that, some of them are a grind, right? So we're working with investors a lot more. The last 3 deals that we moved, we had multiple price reductions on them. And someone lowballed us, and we worked with them on it. We said, okay, we have no other offer, so let's see what we can do. We can't promise that we're going to get this deal done, but we ended up making it work. We ended up getting a $20,000 fee from it because the seller was extremely motivated. So we negotiated the deal down like $60,000, $70,000. So there are opportunities out there for buyers at the moment, working with wholesalers, realtors, anyone really in the industry who's selling properties, right? Because if things are not moving, this is your prime opportunity to negotiate. So we've been pivoting a lot more towards working with the investors and getting any number from them and seeing if it works. And if it doesn't work, it is what it is. But if it does, then fantastic. But our volumes have definitely dropped. Mm-hmm. We're a lot more of a leaner business now, so our margins are better than they were before because really it's the core members, me, Waylon, and a virtual assistant right now, right? Until things pick back up. Being a newer business, we don't want to dry out our capital as well. So
for sure, and because you guys
got money into marketing and growing that way,
you guys were more lean. You were able to do that. In our case, we have over 30 employees in the business. We're not, if we were able to pivot and not have to start losing, team members who we've trained, who are excellent, who have been good to us, and made the company good money over the years, we didn't want to do that. And so our shift was instead to pivot to flip more. And that's why we've bought, I don't know how many we've bought from you, 1 or 2, maybe a couple.
I think it was like 2, maybe 1 or 2. Yeah.
Yeah. We bought a couple off of you guys. Don't forget to reach out to Kat if you have something that's not selling and you think could work for someone as a flip. Let us know.
Absolutely.
We're always looking to buy flips. I think we have 20 on the go right now. Flips across kind of across Canada, really. So the flips are what's because we need to feed our team, essentially we want to keep the team alive. So flipping is just basically to pay the bills. We're just trying to flip enough to pay even to break even until the market recovers, right? We don't want to be, losing money as a business, but the wholesaling itself isn't enough to sustain all of the employees and the overhead and everything else in our company. So that's why we've switched to the flipping model, and we're quite good at it. When I went into real estate full time, I started flipping before I started wholesaling, right? When it was my full-time job. So I started off as a flipper, became a wholesaler, and then have now come back to being a pretty high volume flipper now.
Yeah, and there's opportunity there, right? Because while the market slowed down, the turnkey products were still moving in good locations, and they were still selling at pretty decent prices. Although buyer sentiment for average to below average condition properties was almost non-existent.
Well, and it's really
almost a weird arbitrage.
It previously would have been investors who would have bought those below average condition properties, and the investor sentiment's not there, but the end buyer still needs somewhere to live. And the other side of it too is over the years, we've done so many renovations that we're not really scared of anything anymore. So we take on the stuff as long as the price is right, with tons of mold or the foundation issues or knob and tube wiring, whatever it is, uneven floors. Like if the price is right, we'll take it on, and we can handle pretty extensive renovations now that we're not too afraid of. Whereas a lot of other people are kind of too afraid to do it. And so our price is able to adjust to that, right? So that's helped us out too. And then, yes, it's about bringing it to the retail market, right? Getting it at least livable, but often, depending on what you're starting with, you need to do everything anyways. So we make them quite nice. And we've turned some beautiful renovations over I'm pretty proud of as well.
I find flipping a lot more fun than wholesaling, actually, now that I've jumped into it as well. So you're asking about pivoting. So that's what we did on the wholesaling side. But personally as well, I've been doing a few flips at a time, nowhere near the volume that you're doing. Sort of what I've been doing is, again, I sound like a super conservative person, but at times I'll buy flips in cash, and then do the renovations in cash so I can keep more of the margin myself. Yes, not the most efficient way to scale, but it's more of a side income sort of thing. So I've been finding opportunities where we weren't able to dispo the deal at an assignment fee we would have liked, but I think it's a fantastic deal. Then I would pay the company out, and then I would take down the deal myself, and I would go towards the flipping process. So this year I've done 4 sort of flips at the moment. I have one that's on the market in Toronto. That was a little bit out of my comfort zone. I'm not going to flip in Toronto again. Way too expensive.
Yeah, it's a high price point. Yeah, for sure.
It's a high price point. The land transfer tax, all of that. It's it's much different than the low cost, low ARV inventory. But that's been pretty lucrative for me this year as well. And I think most investors who are flipping this year, as long as you are capable of getting a good deal, you are probably making money, because again, the price gap between the unwanted inventory and turnkey was so wide.
It's gotten much wider than it used to be. And the reason is really, you're saying the people who flip, there's not a lot of them. That's kind of why the people who do flip now can do all right, because a lot of flippers have stopped, or wannabe flippers have stopped. And so the competition for the unrenovated properties, there's just significantly less competition for unrenovated properties. And now it's much easier to negotiate in the discount that actually allows you to flip it successfully. Whereas before, it was very, when the market was hot, it was very hard to find a deal that worked without relying on market appreciation, which is not something I'm comfortable relying on. So before, we flipped very few. We were wholesaling, the majority of our properties, in early 2022 and prior. And then now the majority of our properties are actually probably flips, like more than we wholesale at this point, because that's what we've needed to do. But we've gotten really good at it. We're, negotiating. We've gotten even good at sourcing materials. We're ordering materials from Asia, in volume, even windows for houses. If we have the timeline on them, we get custom windows made and shipped from overseas for significantly cheaper than we get them here. We, kitchen cabinets. We're buying our vinyl plank flooring for houses, 10,000, 13,000 square feet at a time to get volume discounts on it. And then we can just put them through our flips much cheaper. So we're starting to do the volume on the flips has allowed us to kind of have savings on some side of renovations and find ways to save money, which allows us to make a little bit more, just a little bit more on each deal. But, if we can flip 60, 70 houses in a year and we save $2,000 on each house, that's an extra $120,000, $140,000 of income in the year of net, right? So it adds up.
Yeah, no, that's amazing. Just a question for you. When you're ordering that bulk material, where are you storing it? Because your flips are probably all over the place, so you're going to have some way to ship it down.
Yeah, Ottawa is one of our main markets, also where I live, and where we have our in-house construction crew and in-house construction team and project manager. So we have some storage units, and some of my rentals in Ottawa as well, we use the garages for storage. So things like that. In other areas, sometimes we have to ship directly to the site or, kind of order volume, but then have them split the shipment directly to different sites that we know are coming up. We can't do the volume stuff. Like we're flipping in Vancouver, but we only have 2 flips there. So we can't do the volume stuff in Vancouver, which means our construction costs are higher.
For someone who's not flipping at the scale that Luc and his team is, what I've been doing is in Toronto, there are usually like some strips like down Kennedy Road where there are a million flooring stores, a million kitchen stores. Mississauga, they have some industrial areas, and I just go get quotes from multiple of them. Probably not nearly as cheap as the price that you're getting, but for the volume that I'm doing, that's how I'm sort of sourcing things. So when I was doing the 6 unit in Sudbury, instead of ordering the kitchens from Lowe's or Home Depot in Sudbury, I ordered 6 kitchens from Toronto, custom, with the light valence, the toe kick with the crown molding, nicer countertops, all of that. And it was about $200 cheaper per kitchen, including hiring someone to drive them down there. So it was about $1,000 to hire someone to take it from the warehouse in, I think it was Mississauga, and drive it down to Sudbury. But the cost saving was so significant, and the end product was significantly better than just buying something from the big box store. I'm doing what you're doing on a smaller scale, though. Like Toronto is the hub where I'm sourcing.
Well, and Toronto is the better hub to source. We have to source stuff from Toronto to get it to Ottawa sometimes as well, because a lot of construction things cost more in Ottawa than Toronto. And same as you're seeing in Sudbury, Toronto is actually a place where you can find more expensive stuff, but you can also find a lot of cheaper stuff too. We've had good luck with Floorbox online, getting on their emails, contractor emails, like contractor discounts. So Floorbox is a good place for flooring. Even not at necessarily volume, but you get on their contractor pricing, and then they send out like when they have specials. And we've been able to get some very good pricing on vinyl plank flooring through them. There's some stores out in Markham where we order like our hardwood flooring and things like that. So we have to source a lot in the Toronto area as well. And
wherever there's more competition, you're going to find cheaper prices.
Absolutely. We even look like in Montreal from Ottawa, because Montreal's only a 2-hour drive from Ottawa instead of a 4.5-hour drive to Toronto. So sometimes we're looking at sourcing stuff on the Montreal side. So
nice.
Yeah.
Nice.
So let's move on to the next section, which is our digging into your best and worst deals. Let's start with, can you tell us about the best deal you've ever done?
Yeah, I would say one of the best deals that I've done was, so we tried to wholesale this 8 unit. It was in Warren, Ontario. If you guys are on our list, it was one of the first deals we tried to wholesale. So our buyer's list is pretty small at that time. We had it under contract, I want to say for $380,000. It's about 30 minutes from Sudbury, one of those satellite towns, population 2,000-3,000. So not a huge population there. But good opportunity, because the cash flow, the rent rolls were not much different than Sudbury. Maybe it's 10% lower, but the cost per unit was significantly lower than Sudbury. So we picked up that building there, and we weren't really familiar with commercial financing at that time, because most of what I was doing was 3-4 units, 5, 6, even 6 units you can finance with RBC on the residential side. So I haven't done anything on the 8-unit scale at that point in time. So what we did was, instead, we just negotiated directly with the seller in a VTB. Yes, the interest rate was high. I think it was about 10% interest only, which is high, but not the absolute end of the world.
And not at that purchase price, yeah.
Exactly. So we ended up picking up that property there. Again, there's always learning lessons even with a fantastic deal. So we bought that for about $380,000. The market, it was about 50% of market rents all across. It was fully tenanted. So I had to go in there and have that conversation and negotiation with tenants. Fortunately, being in sort of these satellite towns, I found that there was nothing really keeping them there, and they would move from one satellite town to another. It didn't make too much of a difference. And the tenant quality, for the most part, were middle age or a little bit younger, and so obviously it's easier for them to rebound and to move around. There were a couple of elderly people. One of them was really, they were really old. They were on health support, so on and so forth. So And the other one was there for, I don't know, like 10, 20 years. So I realized that I probably wasn't going to be able to negotiate with them. But the other tenants, it was all fair game. And yeah, I was able to negotiate, get 6 of them to move out. I think it was at the average price of $5,000 to $6,000 each. Keep in mind, at that point in time, rents were not the big headline story everywhere. It was got into housing prices. Yeah, so it was a much easier negotiation. And then we put in about, I think it was about $30,000 in renovations per unit for those 6 units. And just recently, the elder gentleman unfortunately passed away, so that unit is vacanted and it's tenanted now. So the only original tenant is that one that's been there for like 10 or 20 years, and they're probably going to stay there until I don't know, they move into some other old home or something like that. But right now, 7 out of the 8 units turned over $30K a unit on average. Plus, we had to spend a lot of money on CapEx. So the siding, we had to do some of the siding. That was another $30,000. We're eventually going to have to do waterproofing, which is probably going to be another $30,000 to $40,000. So there's still a lot of CapEx that's coming up. But we're able to refinance at 70% loan to value just last year as well. I think it was in July or August. So during that rate hike cycle, and it appraised at $950,000, give or take, around there. Okay. And at that point, it was only the 6 units vacant. The 7th unit came that was over the past 5 months or so. So yeah, right now it's probably worth, give or take, $950,000 to $1.05 million at this point. We're able to refinance. I think it should have been the majority, if not all of the capital, and it's cash flowing like crazy. Our rent rolls on that is about $11,000 a month. Wow. And again, we're 70% loan to value, so the cash flow is pretty strong there. But the only downside is the CapEx, right? In retrospect, what I would have done differently is what we chatted about before, to have that negotiation clause in there. Again, you'll learn as you continue to scale. That's what I've been doing more frequently. Another good deal, this will be like a minute. Yeah. Another good deal was last year in November, no one was buying, saw a property on the MLS. It was a 4-unit in North Bay, fully tenanted out, and had that condition in there. They listed it for $500,000 under market rents, got it down to $450,000. Plus, I added that condition in there that I can negotiate. Negotiated. They all decided to move out. And as soon as it closed, it was pretty much vacant upon possession. And then I sold it to someone else for $100,000 more privately. I was going to do the work myself, but I mean, if someone was going to offer something strong, I might as well take it. So sold it to them for $100,000 more, and that was another great deal, right? And that from close to close, from the time I closed that property to the time that other investor closed, it was about 2 months or 2.5 months. Okay. So it was really, really quick. And I'm going to do that again this year, like coming, I guess, next month, the month after. I'm going to be throwing out those offers where I can negotiate vacant possession, because that's really where most of the profit is made on these multifamilies. And if I'm not able to successfully get it done, then no harm done. I just wasted a little bit of time, but hey, I mean, it comes with the game.
Absolutely. No, that's awesome. That's so what lessons would you say you've learned? I mean, obviously you mentioned some, but some of it is learning to put that clause in ahead of time, negotiating ahead of time, because that's where you add a lot of the value.
Yeah, understanding demographic of the building as well. Right now I would probably, unless it's a big building, it's hard to understand a full demographic of a 30-40 unit building. But on these smaller stuff like 7-8 units, it only takes a little bit of time to figure out the tenant quality of each person and figuring out your probability of whether they would accept money to leave or not. I would say budgeting ahead is pretty important, right? So with that siding, with the waterproofing, we didn't include that in our initial BRRRR budget because we didn't need to do it to hit the numbers and refund the money out. But the reality is it needed to get done, down the line.
Yeah, exactly.
Yeah, so it's budgeting out more so the next 5, 6, 7, 8 years. Yes, you might not put all that money out now, but are you going to be having cash outlays somewhere down the line? And that's what I've been doing much more frequently now, because even with the smaller buildings, like with our duplex, we did, I think it was 2 years ago, cash flow positive like crazy, just spent $17,000 on a roof, 2 roofs. for the garage and for the main house. The one I was telling you I'm having a problem with the roofer.
Yep.
That was 17 grand because we had to take out all the metal. There was I think 3 layers of shingles underneath all rotten out. Then we had to put the plywood again. So that was quite expensive. That eroded all of the cash flow since we owned it, right? And that I could have foreseen these things coming if I planned ahead. So I almost get inspection reports now for even properties that already have closed, just so I can sort of build that timeline out of knowing when I'll have cash outlays.
Yeah, that makes sense. That's a good way of doing it. Okay, awesome. So can you tell me about the worst deal or your least favorite deal that you've ever done?
Yeah, I mean, that one's pretty simple. But there's 2 of them. I'll spend more time on one of them and a little bit less time on the other. One of them, I bought a 4-plex in Windsor with a joint venture partner for $300,000. Good price, absolutely terrible neighborhood. Like one of the worst neighborhoods that you can find in Windsor. Negotiated cash for keys. They all signed. None of them left. They were all drug users. So, of course, why would they leave? Then the sheriff eviction was supposed to come. The sheriff never ended up coming because there was I think there were not the ban. There was a hold on evictions at that time during COVID.
Mm-hmm.
So then with these druggies, there were people constantly going in and out, police calls nonstop. It was driving me absolutely bonkers how much time I was putting into this property. And then someone lit the house on fire.
Huh.
So got the call at midnight that there was a fire. Not much more updates other than that. Fire department was there. In the morning, never got an update still, so I went on Google and found that one person passed away due to the house fire. And that scared the living shit out of me. I had to get a lawyer on retainer just in case I have any liability.
Mm-hmm.
Because the property did have knob and tube. The insurance knew that it had knob and tube. I wasn't hiding it, but I was thinking maybe this was a knob and tube issue. What issue would have caused the house to go on fire?
Yeah.
And then found out that later down the line, the Ontario fire marshal came that it was arson.
Yeah.
And obviously, there's nothing I could have done to avoid it, but I could have avoided getting into that investment knowing that it's in one of the worst areas
Mm-hmm.
of Windsor.
Yeah.
So I've been very, very, very specific on the location I choose now. I don't want to invest in bad neighborhoods. It's full of headaches. Even if I was going through the renovations there, I can almost guarantee there's going to be break-ins.
Yeah.
And even if I was to rebuild right now, it's going to be a disaster because I know the demographic around the area. It is not going to be a smooth renovation by any means or development by any means. So we're going to end up soon enough selling that vacant land, but it's free and clear at this point. But that was a disaster of a deal that penned out on paper, $300,000 for 4 units. It was a no-brainer on paper, but all of these outside factors is what made this deal bad, not the numbers.
Yeah, well, I mean, it sounds like financially you still did all right on this, probably because insurance will take care of it. But sometimes our worst deal isn't just the financial aspect. It's everything else. It's the stress, the time, the guilt, the mental load of dealing with it the whole time. Yeah, all of that for sure. I definitely understand. So yes, I personally am okay flipping in a bad area, but not holding. Personally. So.
Yeah, no, likewise. And the second bad deal, this would be just like a minute long. It was a flip. Got ahead of ourselves. It was in a great location. It was a unique property, and people in that area like large lots. It's one of those sort of rural areas. It's near Hamilton, actually. Sort of satellite outside of Hamilton. Very affluent neighborhood. But as a result, people want that big lot and no neighbors nearby. But we bought a property where you could literally see the neighbor from, like, you look outside your kitchen window and you're looking into the kitchen window of the neighbor. And we did discount it. We took a 25% discount on price when running the numbers. Thought that was conservative. What we didn't anticipate was that although you run the numbers in that way, it's just going to end up sitting on the market. And sat on the market, it did. For 2 months, it was sitting on the market, and we were burning through our private money. And that ended up costing us, wasn't the end of the world. We ended up losing $30,000 split 2 ways. That's $15,000 each. Expensive learning lesson. But when doing these flips, I don't want to do anything that is too unique to the neighborhood. And despite the location being amazing, it just sat there. And the feedback was that renovations were great. We don't like that the lot is too small. We don't like that we can see directly into the neighbor's house through our window. So that was another not great deal.
Yeah, absolutely. Unique houses come with unique problems. All right, let's go ahead to the final round, the final questions. What has changed in your approach to real estate investing with your experience?
Yeah. Funny, I was kind of alluding to this earlier without explicitly saying it. I think I'm much more conservative now than before when I started off. It was much easier to be aggressive. I had a lot more to lose, but I think at this point, I still enjoy investing in real estate. It's still a great wealth builder, but I'm taking a lot less risk than I used to, if that almost makes sense. Because I find that, 2022 scared the crap out of me as well as other investors. We saw a lot of people in our industry who unfortunately were not able to make it through. And it occurred to me that leverage is great to build wealth, but sometimes too much leverage can be your downfall as well. And at this point in my time where I'm at financially with my net worth, I realized that the biggest impact that can happen in my net worth is not one bad investment in stocks or anything like that, is by taking a wrong investment that is levered pretty high. Mm-hmm. That could be the one thing that sort of destroys me. Not saying that I'm avoiding leverage. I am still levering up. Like those deals that I mentioned earlier with the fourplex, they're all still financed, right? My most recent flip is financed. My other flip is with the VTB. But I'm much more cognizant of taking those aggressive risks at this point in my journey. As well as, it's a little bit weird, but social media for me has been very inspiring. But at this point, I've started to realize that a lot of investors are flocking to social media. And just having real conversations with people and going to network events, you realize that there's a lot that happens behind the scenes, that everyone has their own trials, tribulations, and sort of issues that they're going through. And that's never really vocalized on social media. So it could give you an unrealistic expectation in investing. And when I have these rise events, which is my network, a lot of them are newer investors. And I hear so many unfortunate stories of new investors that get into the wrong investment property or bite off more than they can chew due to taking on a little bit too much inspiration on what's on social media, right? So I still go on social media from a branding perspective, but I've almost sort of tuned out the competing against other people, if that sort of makes sense.
No, that
right?
makes a lot of sense.
Going at my own pace, but that's what's changed in my journey. Scaling at a much slow, I'm scaling, doing slightly bigger things, but doing things that I find that are easy for me, fun, and less stressful. And for me, that's not big multifamilies. For me, that's 7, 8 units, 6 units. I find they're pretty cookie cutter for the most part. So that's what I've been specializing in.
Nice. The risk thing actually reminds me a little bit when my niece and nephew were visiting Toronto with my brother, and I took them to Wonderland, my niece and nephew. Now, my nephew is a few years older than my niece, and yet we were at Wonderland, and the younger niece, was so much less scared to go on the rides. Mm-hmm. She was so much more ready to take on, any of the rides that they let her on, and et cetera. And then my older nephew was a little more scared. And it's a little bit similar to this, is with experience, you see what can go wrong and you understand what risks there are. When you're young in life or in real estate, you think maybe nothing will go wrong, or that you can get over these things, but you don't see all of the problems that can happen. Whereas when you get a little older, you've seen Final Destination or something, you're like, oh, this is scary now. The younger, so when you're newer, you don't realize the same way. I think it's just kind of an interesting analogy to real estate too, is once you know a little bit more about what can go wrong, you start worrying a little bit more about what can go wrong. But then you can also take steps to get around it, to prevent it. Using less leverage, for example, to protect yourself is a good way of doing that. So
yeah. Or just thinking long term as well. Because as I was investing, everything was quick hits, right? 3-month, 4-month, 5-month turnaround. So I'm not used to, it's an adjustment for me to be like, oh, real estate is actually, it could take 5 years to see a return.
Yeah.
Right. I'm not used to that mindset. So it's an adjustment for me because of the time I got started out as well. So taking that longer term view is what's changed a lot for me too.
Nice. If you could go back in time, what's one piece of advice you'd have for a younger you?
That's a good question. That's a very good question. One piece of advice I would have for younger me is to go out and network build connections and relationships with people in your industry or whatever your goal that you want to pursue. I would say what delayed me from getting into real estate quicker, I mean, I jumped in pretty quickly, right? But I still had a lot of hesitations and doubts because everyone around me was naysayers. And I think a lot of real estate investors, big, small, medium size, can relate. Very few people jump into real estate with everyone saying, that's amazing, especially when you're investing in tertiary markets or secondary markets like Windsor. At that point in time, 08, 09 was still fresh in everyone's mind. So when I told people I was investing there, they thought I was a lunatic, and I started having second questions about everything that I was doing. Right? Fortunately, I was still able to put my best foot forward and get through it and saw the light at the end of the tunnel. And fortunately, I was able to find that Windsor meetup group, because I will say if I did not find that Windsor meetup group prior to closing on that first property, I'm not sure if I would have still be invested. Because in that Windsor group, I saw so many successful real estate investors, people who are retired, people who had like 20 or 30 units at that time over a relatively short period of time. And that inspired me. That made me realize that I was going through the right direction. And when I shared my story with them, it was very similar. When they got into it, people thought they were nuts as well. And even in this point in time, I think no matter what sort of where you are at your journey, there's going to be naysayers and doubters. But that's why you almost want to sort of surround yourself with the people who are doing cool stuff. Right now in the marketplace, there are a lot of people who are taking no action. But you and I are seeing there's still opportunities out there, and we're still monetizing. It's just they're surrounding themselves with people who constantly have the negative thoughts and
tell them it's a bad time, don't do it. Yeah,
exactly.
There's no opportunity. Yeah, exactly.
Yeah, and they're closing themselves out to the opportunities. Whereas when I go to these networking events, someone is always doing something, right? And it could just mean repositioning to portfolio, trying out something new, a new cash for keys tactic, a new sort of financing structure or VTB negotiation, whatever it is. But I find that whenever I go out to these events, I get inspiration once again in real estate. So that would be my biggest advice.
Nice. So the last question, what do you believe is the most overlooked or the most overhyped investing strategy right now?
Ooh, that's a good question. I will say, and I don't want to I'll really hate for whatever strategy you say, that Airbnb may be a little bit overhyped in Ontario and Canada in specific. I was looking at doing the arbitrage model in Ontario, and I did operate in two Airbnbs as well in Sudbury. What I find is that a lot of people that get into it have these sort of false expectations on what they're going to be able to achieve. They're going to think that one Airbnb is going to really retire them, or two or three Airbnbs are going to retire them. I've spoken to arbitragers who are pretty successful in what they do about sort of what is happening right now in the Canadian markets and in Airbnb. And they were the first to say that margins are a lot tighter for any sort of new acquisitions because your rent rolls are significantly higher. If you were to get a new arbitrage unit, you would be paying significantly more in rent today.
Yes.
The furniture cost has gone up, so that means that startup cost and the initial investment has gone up, but your average daily rates have decreased because there's a lot of mom and pop operators who have investment properties who have pivoted to the model if they're not able to sell their property, right? There's a lot of people that are flooding into the Airbnb market, so your average daily rates are going down. Your occupancy rates are going down. So hence your revenue is going down while your expenses are going up. That's a lot more risk. And it's not as fantastic return than when it was 4 or 5 years ago, right? When rental rates were much lower. And it seems like a lot of people are flocking towards this strategy. Not that there's a ton wrong with it. It's more so like taper your expectations and see what reality is, because people will always sort of boost their cash flow numbers. But when you consider all of these expense line items associated with Airbnbs, is it really as profitable? Maybe not. Over an entire scale of 20, 30 units, then possibly it would make a material difference. But like 5 units under, maybe not. And it's a lot more extra squeeze for the juice.
For sure. And look at how well that the person, if you're seeing someone post, for example, on social media about it, are are they actually making their money off of Airbnb, or are they coaching on it or teaching on it? And do they have some sort of bias in why they would want you to, do this or think that it's a good idea for sure?
So
Austin, thank you so much. Where can people find out more about you? How can they sign up for your buyers list? How can they join your networking group?
Yeah, absolutely. So you can follow me, Austin Yeh 6 on Instagram. The networking group is Rise Network. You can just Google it or go on Facebook and you'll find everything on there. To join the buyers list, ontariopropertydeals.ca. And if you just go on Austin Yeh 6 on Instagram, click on my link tree, every single other thing is on there.
That's great. For those, if you haven't heard me say this in a while, you can always sign up for our buyers list at offmarketbliss.ca. Austin, thank you so much for joining me today. I think our conversation was really awesome. I think people are going to get a lot of value out of this. Seeing your experience and all the growth you've had over the years. It's inspiring to a ton of people. So thank you so much for what you're doing and sharing your story.
Yeah, thank you.
All right, take care.